notably in 1980 and 1981. Regrettably, analysts anticipate that the recession will surpass expectations, with the bottom potentially falling lower than predicted, perhaps a 30% to 50% decline in the S&P, around 22,100. While we had a brief respite between 2020 and 2023, the situation is worsening in 2023 due to the concurrent financial crisis. The financial crisis is currently brewing, causing widespread panic. If it materializes, the impact will be severe, marking a dark day for America and the world. It's important to note that each financial crisis carries its unique level of impact, ranging from substantial to less significant losses. Predicting the scale and duration of a crisis is challenging, as evidenced by the subprime mortgage crisis from 2007 to 2008, which coincided with a recession, resulting in a disastrous outcome. The expansion of mortgage credit triggered this crisis, enabling widespread borrowing and mortgage acquisition. This mistake led to the collapse of the U.S. housing market, causing many to lose their homes, savings, and jobs. The repercussions extended globally given America's pivotal role in world trade. Discussions on recession, inflation, and deflation aside, one aspect yet to be addressed, referenced earlier, is the possibility of a global liquidity crisis. In 1998, despite the absence of a recession, the financial world faced a near collapse. Such crises can coincide with recessions, resulting in severe consequences. A notable instance is the subprime mortgage crisis from 2007 to 2008. There's speculation that 2023 might witness a collision between a financial crisis and recession, resembling the 2007-2008 scenario. Financial experts, including Jim Rickards, highlight signs indicating such a development. These signs include a diminishing world trade, daily declines in industrial output coupled with rising unemployment, and historically high interest rates for the past 15 years, aimed at combating inflation but failing to curb inflated prices. If there are lingering doubts about the recession and financial crisis, examining the recent state of American banks provides clarity. In just a month, 5 major banks have faced setbacks, such as bankruptcy, FDIC takeovers, and collapses. The combined losses of credit and stockholders from these events surpass $200 billion, sending a clear signal of systemic issues. Efforts by the FDIC to reassure the public include unconventional measures, such as guaranteeing depositors sums exceeding $200 billion for Silicon Valley Bank and Signature Bank. These unprecedented actions, while seemingly noble, are predicted by Jim Rickards to deplete the FDIC insurance fund, ultimately affecting consumers. Moreover, the Federal Reserve's decision to extend more loans to member banks through the Bank Term Funding Program, BTFP, is causing significant turmoil in the U.S. banking system. These moves have intensified public anxiety, particularly among depositors. Concerns arise regarding whether these actions aim to implement new policies or if they are motivated by the interests of a few affected entities. The parallels to the 2008 crisis, where the FDIC guaranteed all bank deposits, echo in current events. As the government faces unrealized losses exceeding $700 billion in U.S. bank portfolios, the continued cash provision to depositors raises concerns about the sustainability of the banking system. The looming question is whether the crisis is truly over, or if the panic is just beginning. Drawing parallels with the 2008 financial crisis, which started a year and 6 months before reaching a critical stage, the current crisis, only a month old, has already led to the downfall of 5 banks. Addressing the broader economic situation, the FDIC's guaranteeing of all depositors and the Federal Reserve's offer of additional loans through BTFP signify pervasive issues. The Fed's guaranteeing of all bank deposits, surpassing the $250,000 insurance limit, echoes actions taken in 2008 to avert bank runs. However, such measures may strain the FDIC insurance fund, with potential consequences for consumers. As the government grapples with increasing unrealized losses in U.S. bank portfolios, the fear is that continuous cash provision to depositors will hasten the collapse of the banking system. Despite attempts to reassure the public, it remains uncertain whether the crisis is truly averted. The interconnectedness of the banking system and the broader economy becomes evident, reflecting a situation that extends beyond individual instances. The Fed's unusual actions, coupled with the FDIC's extraordinary measures, intensify the prevalent challenges. Considering the gravity of the situation, the looming question is, what should one do? How does one respond to the panic and secure oneself against the impending crisis? While the inevitable cannot be avoided, taking proactive steps to preserve wealth becomes crucial. According to Jim Rickards, the first step is acquiring gold.
Get down 20% in 3 months, getting close to crashing it. So what happens next? First week of January, Powell comes out, okay, we're not going to raise interest rates anymore. We're going to be patient. They use all these code words. We're going to be patient. Then he starts cutting rates. Then he starts QE, I forget if it was 8 or 9, whatever, lost track of QE. He starts QE 8, let's say. And then that takes you into 2020, and here comes the pandemic, and rates go down to 0, and the balance sheet goes to $7 trillion. They were back where they were in May of 2013. Except worse, because now the balance sheet was even bigger than it was then. A complete failure. So who thinks they're going to be more successful this time? They're doing the same thing. It's going to happen faster this time because the market saw that whole 7-year fiasco from May to 2013 to May 2020, a 7-year round trip failure. The same thing's going to happen, but it's going to happen faster this time because the market knows that the Fed doesn't know what they're doing. So the Fed's tightening into weakness. One of two things is going to happen, and it's not clear which, but it's going to be one or the other. They're going to keep tightening and keep tightening and keep tightening, try to get a handle on inflation and crash the stock market. Or they're going to lose their nerve, back off on the tightening, and then inflation is just going to rip, which will also crash the stock market. So take your pick, but it's going to be one or the other. But this idea of a soft landing is nonsense. The 2021 thesis was that, inflation grew. Part of it was base effects because, the way the government calculates inflation, it's monthly data compared to the year before. So it's year over year, monthly, then annualized. And so one could easily explain inflation in April, May, June 2021 because you were comparing it to 2020, which was the worst recession since 1946. But the base effects would run off in September, October, November. But the inflation persisted, even though the base effects were gone. So now it's like, okay, this is real inflation. It's coming from somewhere else. It was coming from the supply chain, which the Fed can't do anything about either because the Fed doesn't drill for oil. They don't build pipelines and they don't grow wheat. The Fed can't do anything about any of those things. And that's where the war and the sanctions and the continuation of COVID played a role. So, I say you can have your own views, but you can't have your own data. The data is clear. The inflation is here.
The renowned economist Jim Rickards continued her speech as follows. The supply chains are deteriorating, but these disruptions in the supply chain did not originate with the conflict. They didn't even commence with the pandemic. They initiated with the trade war led by Trump in 2018. I discovered an excellent book on this topic, authored by Luan Larocco. What's intriguing about her book is that she completed it in late 2019, serving almost as a control experiment. It predates the pandemic. It's convenient to attribute the disruption in the supply chain to the pandemic, which indeed played a role. And the conflict also had its impact. However, we have a meticulous examination of the supply chain's condition before either event, and the conclusion is, it was chaotic. It was chaotic back then due to tariffs on China and China redirecting soybean purchase orders from the United States to Brazil. That may seem straightforward because Brazil cultivates soybeans. Well, guess what? You have to transport the ships to Brazilian ports. You have to reorganize all the logistical lanes. That was already happening. The pandemic exacerbated it, and now the conflict exacerbates it even more. Yes, the world is fragmenting. We're disengaging. Globalization is concluding. There will be a new iteration of it. It's not the termination of world trade, but you might witness perhaps the Five Eyes, UK, US, Canada, Australia, New Zealand, and allies in Western Europe forming a new trading bloc while excluding China and Russia. It will resemble somewhat the Cold War. I discussed this with Paul B. However, in the 70s, something similar occurred. It commenced with cost-push inflation. It was the Arab oil embargo in 1973 after the Israel-Arab War. Then the Arabs imposed the embargo on us, quadrupling the price of oil from $3 a barrel to $12 a barrel. It might sound inexpensive, but that's a 300% increase. Subsequently, we experienced a severe stock market crash and recession in 1974, the most severe since the Great Depression at that time. We've encountered more severe ones since, but back then it was the worst recession since the Great Depression. Following that, the Fed intervened and Nixon abandoned the gold standard. Nixon implemented an accommodating monetary policy in 72, a bit earlier for his re-election effort, etc. So, here comes inflation, but along the way, and then there was another oil embargo, actually an Iranian oil embargo in 1979 after the Ayatollah took over. So there were dual oil shocks. It was a supply-driven cost-push inflation. However, it transformed into demand pull. It evolved into a demand-side scenario that I lived through. I was a young, up-and-coming lawyer at Citibank, a senior officer living in New York City. That was a time when if you desired anything new, furniture, TV set, vacation, anything, you rushed out. You dropped everything, rushed out, and did it because the price was escalating so rapidly. This is instructive in two ways. Firstly, it illustrates that the Fed is consistently behind the curve. It shows that these issues can persist much longer than anticipated. But more crucially, because I believe things will happen more swiftly now, it demonstrates inflation shifting from cost push to demand pull, transitioning from a supply-side matter to a psychological shift on the consumer side. Volcker managed to suppress it, but at a substantial cost. Unemployment reached approximately 11%. He elevated interest rates to 20%. How does that feel? Mortgage holders, student loan holders, and others? 20%. We're talking about 40% on credit cards in that era. People tend to forget, well, doesn't inflation mean you have high growth or whatever? At least low unemployment. No, we had stagflation. We had inflation and high unemployment. There were 3 recessions between 1974 and 1982. We experienced 3 in 1974, 1980, and 1981, which persisted until 1982. By the way, people lost confidence in the dollar in the late 70s. Jimmy Carter's Treasury issued what they call Carter bonds. The U.S. Treasury issued debt in Swiss francs. Now it was Treasury.
You mentioned a fresh perspective on the case for gold, highlighting an impending confrontation within it. Referring to the analogy of tectonic plates, I envision a symbolic representation, perhaps a twig, signifying the fragility of people's confidence within this context. During the keynote presentation at the Sprott Natural Resource Symposium, you began by emphasizing the significance of confidence. Could you elaborate on why this aspect holds such paramount importance in your presentation?
Absolutely. The essence of my presentation focused on gold as the once-in-future money. Historically, gold served as a widely accepted form of currency, yet today, the prevailing belief is that it's merely a commodity, not money. Personally, I view it differently. I consider gold as money and analyze it through that lens. However, this perspective isn't commonly shared. The general consensus disregards gold's monetary attributes and perceives it solely as a commodity. Gold had its prominence as money in the past, but presently, it's not widely acknowledged as money except by a minority, including myself. Yet, I firmly believe it will regain its status as money in the future. The question then becomes, what will drive this shift in perception? To lay the groundwork, I started by questioning the fundamental definition of money. Through various illustrations encompassing feathers, clamshells, euros, gold, silver, beads, digital currencies, credit cards, and Bitcoin, I aim to highlight that throughout history, these diverse forms have all served as money at different times and in specific societies. Criticisms often surface, asserting that certain currencies, like gold, paper dollars, or Bitcoin, lack tangible backing. However, I argue that the common thread among all forms of money is their reliance on one crucial factor: confidence. The crux lies in the confidence shared between individuals in considering something as money. If two parties mutually trust an item's value and its exchangeability for goods and services, it inherently becomes money. This confidence, however, rests upon trust and is exceedingly fragile. Losing this confidence can happen swiftly and is incredibly challenging to restore. Money, as a construct, is far more fragile than commonly perceived because its foundation is rooted in the psychological aspect of confidence, rather than the sheer quantity in circulation. My concern lies in central bankers' disregard for this fragility. Their assumptions about unlimited money printing might lead to crossing an invisible confidence threshold, resulting in a rapid loss of trust and subsequent inflation. In essence, the real essence of any form of money isn't solely tied to economic concepts like printing quantity, but hinges greatly on people's confidence in it. Ignoring this critical aspect poses a significant risk, potentially leading to unforeseen economic consequences in the future.
Certainly. Jim, during your presentation, there was a slide that caught the attention of the entire packed audience, the one where you briefly touched upon the war on cash. However, what piqued interest was your mention of an impending war on gold in the future. Could you elaborate on this aspect as well? It seems like an intriguing and significant perspective that the audience would benefit from understanding further.
Sure. A lot of people have heard the expression war on cash. Governments don't like cash. It's hard for them to trace. And they associate cash with drug dealers, terrorists, and tax evaders. Right. But there are lots of legitimate reasons to have cash. And people who have money in the bank think they can get cash whenever they want. And I make the point that you really can't. You may think you can, but go down to a bank and ask them to give you $20,000 in cash. Let's say you've got $50,000 in your bank account, and you say, "I'd like some cash. Please give me $20,000. They might ask you to come back 3 days later. They might not have that much cash. They'll definitely ask the branch manager to come over because the teller won't be able to handle the transaction for $10,000 or more. They will file a report with the government, the currency transaction report. But even for amounts significantly less than $10,000, if they don't think you've got some cash business like, I don't know, maybe a pizza parlor or something like that, they might file a suspicious activity report. My point is, you won't be treated like an honest American or an honest Canadian or a citizen of the world. You'll be treated like a criminal. They'll do everything possible to discourage you, and you'll find that you actually can't get the cash you think you have. Plus, there are countries in the world. Sweden, I think, is the leading edge that are going to all digital money. They want to get rid of money, meaning paper money or coins. And coins aren't valuable because they're not made of silver. They're made of zinc or copper alloys and so forth. They want to get rid of all paper and coin type money and go to completely digital money. So you have your debit card and your credit card and your wire transfers and your online transfers and all that, but no actual paper or coin type money. Even for the countries or monetary groups that still have paper money, they're reducing it. For example, the Eurozone, the 19 countries that make up the euro, just got rid of the 500 euro note. Until recently, you could get a 500 euro note. There's some still in circulation, but they're going to stop making them. So the next biggest denomination will be the 200 euro note. The United States used to have a $500 bill until the late 60s. Then they got rid of that. Now they have a $100 bill. But the $100 bill of the late 60s, when it was the largest denomination, is only worth 20 cents today in terms of 1960s purchasing power. Even that is kind of going away, not in terms of zeros, but in terms of what it's actually worth. So there's a full-scale war on cash. The point I'm making is that people say, "How's it going?" I said, well, it's over. The government won't think. You may think you can get cash, but you can't. But you can get gold. There's nothing stopping. I was in London recently. I went to a place called Sharps Pixley. It's a gold bullion dealer right on the corner of Jermyn Street in St. the kind of fanciest shopping district in London, one of the most attractive retail locations in the world, and you can walk in right off the street. It looks like a bank, but it's not a bank, except maybe it is a gold bank. Walk out to the teller, say, "I'd like to buy 1 kilo of gold." They'll say, "Fine. That's $45,000 and pay with a credit card." Or, "I want to buy a couple of gold coins." And they'll say, "Fine." They won't say dollars. Obviously, they'll say pounds, a couple of £1,000, etc. They'll give you the gold there. If you want to store it, you can store it. They have safe non-bank storage. If you want to walk out the door with it, that's okay too. It's kind of like a knight in the 19th century in London. You could walk up to a normal bank and give them paper money and they would give you gold and you could walk out with it. So Sharps Pixley has reinvented that kind of bank of gold concept. There are very few barriers to owning gold. Sprott has a very good gold fund. There are other gold funds of that type around the world. You can store it yourself. You can get non-bank storage. Don't put it in a bank. I don't recommend that. But non-bank storage is fine. So right now you can get gold, not at a fixed price. It's not a gold standard, but at the market price. I think the governments haven't really caught on. They've spent so many decades disparaging gold, making fun of gold, ridiculing gold holders and sort of running gold off the road that I don't think governments are alert to the fact that gold is money. And if you make cash go away, you're actually going to elevate the value of gold to a lot of people. And so I expect that when they suddenly wake up one day and say, wait a second, all these people we tried to chase out of paper money, they're going to gold. There'll be a war on gold. And my advice to people interested in gold is get it now while you still can. Are you waiting for? Some things are changing quite a bit. Some things haven't changed. So some of the fundamental forces are the same. Now, superficially, we've had a lot of news. We've had Brexit. We've had the unexpected rise of Donald Trump. We've had a Turkish coup. And we've seen Venezuela implode. So there have been a lot of very important, very significant political and geopolitical developments can impact gold or commodities one way or the other. But certain things haven't changed. And I think these are important to focus on because they really drive the price of all commodities. The number one thing is the struggle between deflation and inflation. And this is something actually I talked about in my first book, The Currency Wars in 2011. I made the point because people look at the time series of price indices and we haven't had a lot of either. They've been pretty steady at a pretty low level, around 1.5%, sometimes a little hotter, sometimes a little cooler, at least in dollars. Now, actually, some of the other economies around the world, you're actually seeing deflation in Japan and Europe and elsewhere. But that is because the world is in a naturally deflationary state. The world wants to deflate. Why is that? Demographics. You not just have a slowdown in growth. Globally, you do. But in certain countries, you actually have declining populations. The population in Japan is declining. The population of Russia is declining. The population of China has leveled off and may start to decline. The only reason the US doesn't have negative population growth is because of immigration. The actual birth rate of Americans, ex-immigration, is sort of flatlining. But we do have some population growth because of immigration, but that just means it's coming from somewhere else. And then debt and deleveraging. Talk about helicopter money. We'll just give people money and they'll go spend it. Well, they might not spend it. There are two other things you can do with it. You can save it or you can pay down debt. So just handing out money on street corners doesn't necessarily get you the velocity or the turnover of money or the spending or the GDP that you want, because people might actually, as I say, put it in the bank or pay on debt, and that is going on. So that's debt to leveraging. The third one, of course, is technology, which is a good thing. People say there's bad deflation caused by bad policy, but there's something called good deflation. Maybe we should have another word for it. But when your standard of living goes up, not because you're making more money, but because your cost of living goes down for the same amount of money, you can have a better lifestyle because things are less expensive. And that was predominant in the United States. For example, in the late 19th century, when it was an age of invention, you had the McCormick harvester, the expansion of the railroads, the telegraph, the telephone, the phonograph, and movies. All those things came in the late 19th century, maybe very early 20th century, all of which lowered costs and made people richer without more money, just meant they could do more things were less expensive. So debt to leveraging, debt to leveraging, demographics and technology are causing. I call that the natural state of the world. However, central banks cannot have deflation. They cannot allow it. And I have this debate with our friend Harry Denton and Gary Schilling and others, because they do the deflation analysis I just went through, and I agree with them on that. I think that analysis is correct, but there's a countervailing force, which is central bank policy. Governments cannot have deflation because it increases the real value of the debt. I mean, governments are over-indebted as it is. Japanese debt to GDP ratio is over 250%. Corporate debt, actually corporate, individual, and government debt in China to GDP ratio is over 300%. I mean, these are huge numbers. People pick on Greece, but the rest of the world looks a lot like Greece or is getting there fast. So deflation increases the real value of debt. So if you're over-indebted to begin with, the last thing you want is deflation. There are other reasons why governments don't want deflation, but they're determined to stop it. So you've got these two tectonic plates. There's the natural tectonic plate of deflation, but there's the policy plate of inflation, which is money printing, currency wars, QE operation, twist, all the central bank toolkit, negative interest rates, zero interest rates. They're pushing against each other. So it kind of looks stable from the outside, but it's dynamically unstable, going to snap. The question is, which way would it go? Central banks could throw up their hands and it could go deeply into deflation, or central banks could pull a few more rabbits out of a hat and it could go into inflation. That kind of monetary instability is part of the case for gold, kind of part of the new case for gold, as I call my book. But the point being, that hasn't changed. This has been going on for 5 years, and except that the forces keep getting stronger. The forces of debt deflation, negative interest rates, deleveraging get stronger. The forces of money printing and policy, and I think we'll soon see world money in the form of special drawing rights, or SDOs. So these forces are not only coming together, they're getting more powerful, and they're going to snap when no one knows. But you can say that it certainly will happen. The effect will be dramatic. When it does happen, I definitely want to own gold, at least for part of my portfolio. but I do have the sense that we're getting closer to some very significant break in the system.
Slowing industrial output, slowing retail sales, and importantly, for investors, a very sharp decline in inflation. So this is one of the kind of mystifying points about the U.S. stock market. I mean, it seems straightforward to me, but the market has their own dynamic. They're saying, well, if the Fed raises rates the way I described and they cause a recession, the Fed's going to have to cut rates. That's called the pivot, the Fed pivot, and lower rates are good for tech stocks, so buy stocks. But think about that for a second. What if inflation comes down faster than the Fed thinks? And I think it may, by the way, I'll return to that. What if inflation comes down really fast and they get to the target rate sooner than they think? Does that mean they might have to cut? Well, it might, but what's good about that for stocks? I mean, if that happens, no one ever says, why did that happen? They just say, well, inflation may come down, interest rates may come down, so buy stocks. It's like, well, inflation may come down, interest rates may come down, but if it does, it's because we're in a very severe recession, exactly what I'm forecasting. And so if that's the case, stocks are going to plunge, 30, 40, 50%. So don't root for lower rates, or if you're forecasting lower rates, understand what that means. It doesn't mean the Fed chickened out. It doesn't mean life is wonderful and you should buy tech stocks. It means that we're in the very severe recession that I described, and I think we will end up there. And therefore, stocks are going to plunge. So, be careful what you wish for, as they say. My forecast is, yeah, they are going to raise rates. They're going to over-tighten. They're going to cause a very severe recession. And when they do, they may pivot at that time, but it won't be for good reasons. It'll be for very bad reasons, meaning we're in a recession and stocks have plunged. So don't buy into the Wall Street chatter as far as that's concerned, because as I say, the Fed's going to over tighten.
Now, why isn't the Federal Reserve aware of this? Well, because they never are. Because they have the poorest forecasting record of any institution I can think of. Their entire history since 1913 is one mistake after another, and this will just be the latest in the long series. So, just to kind of recap, the Fed is on a trajectory. We know precisely what it is because they informed us. All you have to do is listen to them and believe them. They're going to increase rates, let high rates do their work, and observe the inflation come down, and maybe in 2024 decrease rates. What I anticipate is they are going to raise rates for the next couple of meetings exactly as I've outlined, but they're going to over-tighten. The signs of recession are already present. The Fed's not looking at them. I'll come back to what they are, by the way. And we'll be in a very severe recession for a lot of reasons. And that's going to mean a plunge in stock prices. So if the Fed cuts rates, don't cheer too loudly, because it'll be in a world where severe recession, higher unemployment, and crashing stock prices are the norm. I'd like to conclude on I can't call it a joyful note, but a global liquidity crisis. Now, I talked about a global recession, and people go, well, isn't that like a liquidity crisis? No, a recession or a depression is very different than a liquidity crisis or a financial panic. They're two different things. They can and do happen separately. In 2008, we had both. In 2008, the recession or depression and a financial panic converged, so they can happen together, but they don't have to. They can happen individually. What we're in for visually looks like a global financial crisis and a global recession at the same time, coming sooner than later. Now, why do I say that? There's a global dollar shortage. People go, wait a second. The Fed printed $9 trillion, which they did in 2020. It's come down since then, but they did print that much money. How could there be a global dollar shortage? What people don't understand is that behind the curtain off-balance sheet, this is off-balance sheet. You've got to go read the footnotes and understand what you're reading. There are $1 quadrillion of derivatives. And for those not familiar with quadrillion, 1 quadrillion is 1,000 trillion. So, I just said the Fed printed $9 trillion. Maybe it's down to 7 trillion, but you have $1 quadrillion of derivatives, and they have to be supported with collateral. Not 100%, not even 10%. I mean 1% or 2% is enough. But when you're in a liquidity crisis, banks are extremely choosy about which collateral they'll accept to support this $1 quadrillion inverted pyramid of derivatives. And right now what they're saying, because this evolves, it gets worse. It doesn't happen overnight. It can become acute overnight, but it happens over the course of a year or longer. What we see, the banks are saying, I don't want corporate bonds as collateral. I don't want your mortgages as collateral. I don't even want 10-year treasuries as collateral. The only collateral I want are short-term U.S. Treasury bills. Treasury bills have a maximum maturity of 1 year, 360 days, but there can be 4-week bills, 8-week bills, 6-month bills, etc. That's the best form of collateral. It's the most liquid, easily traded, low volatility, easy to repledge, is by far the best form of collateral. That's all the banks want right now. But if you're a foreign bank, you need dollars to buy the dollar-based collateral. If you want treasury bills that are denominated in dollars, you need dollars to buy the bills. That's why the US dollar is so strong. People go, wait a second, the US has a multi-trillion-dollar annual budget deficit, a massive trade deficit, 132% debt to GDP ratio, $31 trillion in debt. You're going into a recession. How can the dollar be so strong? The answer is everything I just said has nothing to do with the demand for dollars in international foreign exchange markets.
The constant rise of the markets is perplexing, isn't it? Despite the less than stellar state of the economy, ongoing political turmoil, and the overall uncertainty within America, I have some pressing thoughts to share, and I'm eager to hear from our expert, Jim Rickards. Jim, here are the queries. How can stocks continue to climb amidst the looming threat of World War III, ongoing conflicts, soaring national debt, and a chaotic political landscape? Another question that's on everyone's mind is why the stock market seems buoyant despite the barrage of negative news. Investors and Americans alike are seeking answers, Jim. What's your perspective on this perplexing situation?
The S&P 500, the Dow Jones Industrial Average, and the NASDAQ 100 all peaked in late 21 and January 2022. Look at a 3-year chart. Stop looking at a 3-day chart. People in general stop looking at 3-day charts, at a 3-year chart. They all peaked in NASDAQ, peaked in November 2021, and Dow Jones and SP peaked in January, like the first week of January 2022. Those indices are down significantly from where they were almost 2 years ago, or over 2 years ago. So you can talk about the bull market all you want. They're down over the last 2 years period. Now, has there been a rally lately? Yeah, and there have been 4 or 5 along the way. And I'm not saying you can't make money, but I'm saying that in this volatility, up and down, the trend is down. So let's not get too excited about the stock market because the trend is down as I described. Just look at a 3-year chart. You'll see exactly what I'm talking about. Now, where do we go from here? Oh, stock markets are bubbly in the face of something horrible, where we've seen that before. I mean, the stock market during the cycle around the 2007-2008 financial crisis. Remember that crisis started in the spring of 2007, kind of reached a fever pitch in August 2007. That was when Cramer had that famous meltdown with Aaron Bernard on CNBC. They know nothing, etc. But the stock market actually peaked in October 2007. So there we are, 6 months after HSBC warned about rising defaults and mortgages, 2 months after the Fed almost caused a meltdown. Jim Cramer called them out in August 7, but the stock market peaked in October 7. So stock markets go their own way. They're supposed to be leading indicators. They're really not. First of all, the stock market is not peaking. The peak was 2 years ago, right? And the peak is exactly when I said November 15th, 2021. So that's more than 2 years ago, and it still has not regained that peak. So that's the reality. You're right, Matt. There are some rallies, but there's some big dips along the way if you're looking at it. Okay, right now we're in kind of rally mode. Why is it rallying? This started in kind of mid to late October. The Fed signaled that maybe they're done raising interest rates, and maybe they are. We'll talk more about that as we get closer to the, if interest rates go down, stocks go. That's the narrative. Wall Street always has a narrative for no Goldilocks. Soft landing. There's no such thing as a soft landing, by the way. There are hard landings. There are crashes and there are booms, but there's no such thing as a soft landing. You're going down. You're going down. That's why stocks are rallying right now, because interest rates are coming down. But what people don't stop to ask is, okay, interesting, why are interest rates coming down? Could it be we're in a recession? Could it be we're seeing disinflation, maybe even deflation? Could it be industrial production was down, which it was? That was reported the other day. Initial claims are up. That was reported the other day. Unemployment ticked up a little bit, not huge. But in the last employment report at the beginning of November, This is in addition to the more technical signs. I don't want to get too far in the weeds in terms of inverted yield curves and negative swap spreads and a lot else. Those are long-term or long-range indicators of recession. We've been talking about those for a year. They're very powerful indicators, but they don't tell you the exact timing. But the other items I mentioned, things like industrial production and so forth, are much more real-time, and they're all turning negative. So I would expect the stock market to turn around and kind of go down significantly between now and the end of the year, early next year. Certainly, because by then the data will be undeniable right now. Again, the Wall Street Goldilocks soft landing scenario prevails. It doesn't mean it's right. It just means that that's what people believe. But Wall Street, again, they're just trying to sell you stocks. They'll sell you stocks right up until the day it crashes. I'm actually writing one of our newsletters. I'm writing it today, and I went back and looked at the recessions in 1974 and 1981, and the Dow Jones in 1974 recession. The Dow Jones fell 45%. At today's level, that would be the equivalent of 15,000 Dow points, slightly more. So imagine the Dow Jones down 15,000 points. That's a 45% decline from today's level. And that's what happened in 1974. It's not ancient history. What caused it? Well, it was a war in the Middle East, and Arab oil and bar went higher. Oil prices sound familiar. I mean, that's kind of what we're going through right now. We're going back to 2021, the supply shock. And then in 1982, 82, that recession, the NASDAQ fell 38%, so peak to trough. So that's what a real recession looks like, and that's what a stock market crash looks like. And so we could be heading for something like that. But it peaks when it peaks. But by the way, it peaked 2 years ago, so we're not even at the peak. But yeah, it could go down 30, 40%, maybe 50% from here.
I would say that the Fed's monetary policy will fail or is failing, and fiscal policy will fail, is in the process of failing, even if gold didn't exist. If you didn't have gold as a multi-millennial monetary standard, even if gold wasn't there as a reference point, which of course it is, but these policies are failing anyway, and there are a lot of reasons for that. Whenever I hear fiscal stimulus, I say, well, no, the Fed can print money all day long and the Congress can spend money all day long, but don't call it stimulus. It's not going to have any stimulative effect. We're way past the Keynesian multiplier, which is now below 1, meaning if you borrow $1 and spend $1, you don't even get $1's worth of GDP. You get some numbers, 70, 80 cents. Forget about the multiplier. It's actually now, a divide or something that reduces GDP. You don't get the GDP for the borrowing. And same thing with monetary policy, because unlike Milton Friedman, the monetarists, the neo-Keynesians, the Austrians, and everyone else, money printing has nothing to do with inflation. And they seem to, well, I don't know if they ever knew it, so I can't say they forgot it. So all the money printing and all the deficit spending will not stimulate the economy. And that's true anyway, but gold is signaling that. Look, all markets try to be forward-leaning. Some do it more successfully than others, more accurately than others, but they try. I would say that, yeah, people say, the stock market is an efficient discounting mechanism for future events, for what they see in the future. And yeah, they look into the future. Here's their forecast. They pick out a discount factor. They present value it and say, here's where stocks should be today, based on where things are going to be, 6 months or a year from now. And that's what they do sort of mathematically and analytically, except they're always wrong about the forecast. You got to get the forecast right if the discounting process is going to mean anything. So markets go through the process, but they always get the future wrong. They're not very good at predictive analytics. So this creates what I call the gap between the perception and the reality. Reality always wins, but not right away. Sometimes it takes a while. Gold, on the other hand, has very high predictive analytic value, number one. Number two, it's more forward-looking. So gold's kind of telling you where things are going to be maybe a year to 18 months from now instead of 6 months from now. And so, so gold is signaling that monetary and fiscal policy will fail and something else will be tried. And that ultimately will result in a much higher price for gold. So gold's just saying, well, let's do it now. Look, I've got gold at $15,000 an ounce by 2025. If I'm wrong about that, it'll be sooner and higher. But that's Well, I consider that a conservative forecast, and we can maybe take a few minutes to go into the analytics behind that. As I've said before, you've heard me say, I don't just throw numbers out there to get attention. I don't really care. I do care about getting the analysis right. There's a number of different techniques, and what's interesting is they all point in the same direction. So it's got to go to 3,000 before it gets to 15,000. It's got to go to 5,000 before it gets to 15,000. So that's my kind of long-range forecast. But, it could go down tomorrow. And I'm like, I don't get depressed when it goes down. I don't get euphoric when it goes up. I know where it's going in the long run. That's the important thing if you're trying to preserve wealth and make money. Nothing wrong with making money. I'm all for it. But sometimes preserving wealth, risk aversion is a higher priority than just making a lot of money in the short run. But either way, gold will serve that purpose and preserve wealth over that time period. Could it go down tomorrow? I guess, yeah. But all the vectors are pointing up very strongly. I'll give you a concrete example. There are three things that drive the price of gold fundamentally. One that you've already mentioned, which is real interest rates. The lower the real interest rate, the higher the price of gold. Number two, supply and demand. You learn it in your first 3 days in economics, but it still works. And then number three is geopolitical risk. Call it risk off or fear factor, whatever you want to call it, but I think of it in geopolitical space. Those three vectors don't all have to point in the same direction. You could have a situation where geopolitical risk is high, pointing to a higher gold price, but real interest rates are really high, and that would point to a lower gold price, etc.
Small ebook, big impact, The Wealth Tree. The only 4 ways that will make you financially free forever. Download it here for free.
But right now, all three of them are flashing green or maybe flashing gold. The real rates are coming down. They're still high, by the way. I always have to just roll my eyes when really smart people, Dan Isaacson, Bill Gross, Jeff Gundlach, and I admire them all and I follow them all. But they've all been carried out feet first on this, bond bubble thing, the greatest bond bubble in history, and short bonds, and the interest rates have nowhere to go but up. They're just failing to distinguish between nominal rates and real rates. Nominal rates are low. Real rates are not low. When I say low, I mean, show me negative 4%. That's a low real rate. Yeah, you can pick your notes or your bills or whatever, but I usually use the 10-year note rate, 10-year treasury, because it's a good proxy for building, construction, long-term investment. People don't borrow overnight to build a building. They borrow for 7 years if they can, et cetera. So to me, that's my proxy for sort of economic growth and inflation forecasting. It's about 70 basis points today, etc. But inflation is, 1.5, take your index. So that puts the real rate, maybe negative 25, negative 50 basis points. Well, thank you very much. But, I remind people in 1980, I borrowed money at 13%, but inflation was 15%. And my borrowings were tax deductible, and the tax rate, I lived in New York City at the time, was 50%. So my real after-tax rate was about negative 7. That's a low real rate. So the point is, we have a long way to go. And it doesn't matter, people are interested whether the Fed's going to pursue a negative interest rate policy, take the target rate on Fed funds below zero. Legally, they could. It's already been done in Europe and Switzerland, Japan, a few other places. I don't necessarily forecast that. I don't think the Fed necessarily wants to go there. But you can have negative yield to maturity on a 10-year note. Just whenever the premium is greater than the present value of the coupons, it's a negative yield to maturity. So you can get there. You can get deeply negative rates in secondary market trading, regardless of what the Fed does. And that will happen. And so, in the DV01, dollar value of 1 basis point is higher as the absolute level of rates gets lower. That's just, duration, just bond math 101. So we're going to have huge capital gains in 10-year notes as the yield to maturity goes, towards negative 1%. But that's going to be an enormous boost for gold. We're not even there yet. We're seeing we're seeing kind of a spike in gold prices when real rates are still, relatively high. They're only mildly negative. I was declarative when I said printing money does not cause inflation, and it doesn't. Again, I'll just use the last 12 years as Exhibit A. We should probably relate to the viewers what does cause inflation. And the answer is velocity, the turnover of money, the lending and the spending. But the problem is velocity is a psychological phenomenon. The Fed can stick the landing on money supply. They can get it down to a couple of decimal places if they want. But if you want to control velocity, which is the key, that's psychological. So what you have to do is change the psychology. Well, what is the psychology right now? It's deflationary. The savings rate in May was 33%. It had been going up. It kind of made its way like from 4% to 7%, but then it spiked to 33%. Well, savings is a good thing. You can drive an economy if you can convert savings into investment. And furthermore, if the investment is productive, unlike what China's doing. But we got some infrastructure or some other projects, R&D, that would be productive. That can drive an economy. You don't have to drive an economy on consumption. You can drive an economy on productive investment. But the problem is twofold. Number one, it has a much longer time frame. That's a 5-7 year time frame. And it comes, in the short run at least, at the expense of consumption. Our economy is driven 70% by consumption. If you substitute savings for consumption, you're killing velocity. Because if I put my money in the bank and leave it there, the velocity is zero. And I remind people, $5 trillion or $6 trillion times zero is zero. You can print all the money you want, but if you don't have velocity, you don't have an economy. And so the question is, how do you change the psychology? How do you get and by the way, it makes sense to say, if you're unemployed, you better be saving because you're maybe lucky if you can pay the rent. But even people who are working or still have their jobs, they're worried, maybe I'm next. Maybe they fired the guy down the hall, but maybe I'm next, and maybe I better save more just in case, and so forth. So, and that's not a bad thing. I'm not saying that doesn't make sense. That makes a lot of sense, but understand what it means. It's deflationary. It reduces velocity. It offsets the increase in the money supply, and it's very hard to get out of. I mean, Keynes called it a liquidity trap, and he was right. That's what it is. So how do you change the psychology? Well, you need... Supply chain is not part of the economy. Supply chain is the economy. In other words, if you want to understand the economy, you're really talking about the supply chain at every aspect. Something as simple as a loaf of bread. You buy a loaf of bread at the grocery store. Like, okay, well, I guess it came from a baker, and I guess they took it from the bakery to the store by truck. So there's a supply chain. Well, that's about as simple a version of the supply chain as you can imagine. You have to just start going from there. It's like, well, did the bread come in a plastic wrapper or a paper wrapper? Well, that wrapper came from somebody. Where'd the truck come from? Well, obviously a truck manufacturer. Where'd the driver come from? Somebody had to make a career choice and be trained. And what about the diesel fuel in the truck? That came from a refinery, and that came from oil exploration. Then you get back to the baker, and it's like, oh, well, I guess he had an oven or she had an oven. Where did that come from? And then you find out that the ovens are, industrial ovens have parts from 25 different countries and so forth. Well, without belaboring that point, you get back to the farmer and the wheat and the fertilizer and everything else, and really what's called the extended supply chain. And you're like, wait a second, that's a huge number of countries, a huge number of imports, and a big part of the economy, which it is. And then every link in that supply chain I described has its own supply chain behind it to get to source materials and intermediate manufacturing and so forth. And then that's for a loaf of bread. Well, what about your car, your furniture, your clothes, and on and on and on. Once you start thinking about what supply chains are, you realize it's just the cardiopulmonary system of the entire global economy. So, the supply chain book shines a light on the entire global economic process. And I have whole chapters on that talk about China, the war in Ukraine, and climate change. And you say, well, the interesting topics, but what do China, Russia, and climate change have to do with the supply chain? Well, the answer is they are, kind of global macro earthquakes. Russia's invasion of Ukraine led to sanctions against Russia that affect everything, imports, exports, strategic materials, semiconductors, fertilizer, oil, natural gas, etc. Again, you're saying, well, okay, Boeing makes aircraft. They need titanium and aluminum. Where does that come from? Turns out about 30% of it comes from Russia. So how are you going to keep the Boeing assembly line going when you're shutting down strategic metals from Russia? I can go kind of on and on there. China, everyone says, well, they've slowed down because of the zero COVID policy. And that certainly has been detrimental to their economy. Shanghai, a city of 26 million people, Beijing, a city of 22 million people, they were both locked down entirely last spring. When I say entirely, no transportation in or out, nobody on the streets. You had some essential workers, people had to get to work. You had to have a COVID test, a negative result that was not more than 2 days old. So these were extreme lockdowns and obviously very, very detrimental to the economy. Now, those have died down a little bit, and China's saying, now we're going to relax our zero COVID policy a little bit. So what's new? Why are supply chains breaking down? What's new about the supply chain that makes it different than any other period in the history of the world? And what's new were two things, and they arose around 1989. The first was you had a combination of increased computing power, algorithms, artificial intelligence, better data collections, and new models. So you suddenly had the computational telecommunications and data and mathematical tools to be a lot more sophisticated about how you handle the supply chain. But the second thing that happened at the same time was 1989, the fall of the Berlin Wall, 1991, the collapse, the demise of the former Soviet Union, which gave rise to new trading partners in both in Eastern Europe, where they were no longer behind the Iron Curtain, Poland and Romania and Hungary and many other countries. And at the same time, you had the rise of China. China did have a fairly high growth period in the 1980s, but nothing like we see today. And it all came crashing down in 1989 with the Tiananmen Square massacre. And that really shut down U.S.-China relations, not fully, but there was no Western investment coming into China. The two countries were distant. Well, that ended around 1992. Deng Xiaoping did what he called the Southern Tour, where he reaffirmed China's commitment to capitalist principles. They weren't overthrowing communism, but they were embracing capitalist market ideas. There was a thaw in U.S. relations, and then it was like, no holds barred. Then that's when the U.S. investment really did pour in. So all in a short period between 1989 and 1992, you had the fall of the Berlin Wall, the fall of the Soviet Union, new republics. China kind of re-enters the game, and all this was globalization. So now all of a sudden you had the science I described, computing and artificial intelligence and applied math, and a true global market. So now the supply chains could go 9,000 miles from Chongqing to New York, or from Shanghai to Seattle, or London to Hong Kong, of course. So this was true globalization, much larger scale, much longer supply chains, and it worked. And so this was a period I call supply chain 1.0, 30-year period from 1989 to 2019. Now, why did it break down around 2019? Three things. A lot of people look at the pandemic and they go, oh yeah, COVID, that disrupted everything. That was the problem. And some people look at the war in Ukraine and the Russian sanctions and go, that was the problem. And they both made it worse. No doubt about it, made the supply chain worse. But it really started in 2018 with Trump's tariffs on China. So Trump put tariffs on appliances and solar panels. Well, China didn't stand still for that. So China said, well, what can we do to strike back? Well, at the time, China was and is the world's largest importer of soybeans. They need the protein. They don't have enough. The U.S. and Brazil are the two largest exporters of soybeans. Well, China was buying all their soybeans from the United States because they were trying to reduce the trade deficit. We were buying so much stuff from them, and China said, well, what can we buy from the U.S. just to kind of balance the books a little bit? And the answer was soybeans. Well, when Trump put the tariffs on, China redirected all of their soybean orders to Brazil. They stopped buying U.S. soybeans and they bought them all from Brazil. Well, there's a lot more to that than a phone call. You got vessels and dry bulk carriers and transportation lanes and port facilities. And, if you're Brazil and you get all these orders, you got to get trucks to get the soybeans to the ports. You got to open up port facilities, et cetera. The point is, this is a major, major shift in global logistics, just to change the order book from the U.S. to Brazil. Beyond that, people involved in this, they don't want 6-month contracts. They want 5-year contracts, or at least 3-year contracts, and they got them. And so now all of a sudden, China's buying all their soybeans from Brazil, but this scrambled global supply chains. Now, what are the U.S. farmers doing? We're still growing the soybeans. We can't sell them to China. Well, it turns out the Netherlands needed them. So, okay, we'll sell them to the Netherlands and distribute them to Europe, which they did. And then this went on and on because Trump put more tariffs on to retaliate. China took more actions against the United States, canceled purchase. So, and it escalated from there. Now, again, COVID made it worse. The war in Ukraine made it worse. But it's very clear that that's where it started. So that's why I use 2019 as just, kind of an arbitrary date with a 30-year period of supply chain 1.0. Now we're getting to supply chain 2.0. but we're not there yet. We're in this like messy, in between, inefficient, muddling through period where things are broken, but they'll never be put back together the way they were, but we haven't produced or created the new model supply chain. We're just muddling through, and with a lot of disruption, a lot of empty shelves. You have to understand, it took us 30 years to build this. We blew it up in about 3 years. It's not going to come back overnight. It's going to take 5 or 10 years or maybe longer to rebuild in some form. We may have a very bad recession, possibly worse than 2008. So tell me why it's a buy signal for stocks if the Fed is throwing the economy into such a bad recession that unemployment is going to go up significantly and growth is going to come down, inflation is going to come down. Why is that a buy signal for stocks? Maybe at the bottom, and the bottom might not be till late 2023. Okay, yeah, there are opportunities to buy the bottom, but we'll be nowhere near the bottom. Bear market rallies are really interesting. Some of the biggest rallies in history have been in the middle of bear markets where you ended up losing everything, but for a couple of days or weeks even, it's, hey, the bottom's in, and you buy stocks, et cetera. So you have to watch out for that. So we're flying into a really bad recession. The stock market's starting to get the message, but you've got this pivot narrative. You can't quite get rid of some of the buy the dips people are still around. So count on them to buy into what could be a horrendous bear market. You got your buy and hold crowd. Remember in 2000, 2001, the NASDAQ dropped 80%. And a lot of people got out, but they said, well, just hold on to it. Well, it did come back, but it took until 2015. I mean, that's a long time. A lot of people died in the meantime. You're waiting 14 years to get back to where you were. So those people are still around, but there is what I call the pivot crowd. So the Fed pivot is a narrative, and it kind of goes like this. Yeah, the Fed's tightening. We see that. Inflation is going to come down really fast. The economy is going to slow down really fast. Both of those things are happening. Inflation, a little less so, but the economic slowdown is there. And the Fed's going to get the wake-up call and have to cut rates. And cutting rates, that's the pivot. They're going to pivot from rate hikes to rate cuts. And that's good for tech stocks, so buy stocks. Now, that's the narrative. It prevailed in late July and most of August. The stock market did go up. There was a decent rally in the middle of what's become a bear market based on this Fed narrative that they were going to have to cut rates. There are two huge fallacies in that narrative. The first one is who says the Fed's going to get the message? And if you look at what Jay Powell said and what he repeated, we're going to raise rates, we're going to crush inflation. I've been following this for 50 years. I've never seen a Fed chairman use the word pain 3 times in one paragraph, but he did, and he meant it. He knows there's going to be a recession. They're causing it in part. Unemployment's going to go up. He said that. He tied unemployment to killing, basically demand destruction and getting inflation under control. He said, that's how we're going to do it. And you're already starting to see some early signs of that. So with that as their focus, who says the Fed's going to, get a wake-up call? Almost certainly not. I mean, they told us what they're going to do. They're going to raise rates. And then he said, if we see progress on inflation, we'll pause. But pause doesn't mean cut. It means just wait a long time, because at that point, core PCE, that's personal consumption expenditure, core, which excludes oil and food, and that's just how they do it. That's their favorite metric. You can debate whether it's the best one, but the debate doesn't matter because that is the one they use. Let's say that comes down to around 3.5. Okay, it's still not 2. Now, what Powell, which is their target, so what Powell said is, we don't have to keep raising rates to force it to 2. We just have to raise them enough that it'll get to 2 on its own. That's what they call restrictive policy. So, but that's not a rate cut. He said that might last for a year, all the way into 2024. That's when he was talking about rate cuts. Now, again, this can change, but they've told us what they're going to do. I always say, forecasting the Fed's the easiest thing I do, because they actually tell you what you're going to do, what they're going to do. You just have to listen and believe them. Now, the hard part is understanding how badly they're going to destroy the economy and when they're going to get the wake-up call. That's the hard part of the analysis. But telling what they're going to do is the easy part, because they kind of tell you. So the stock market notion that somehow they'll be cutting rates is just false. I was around for the 2008 financial crisis. I was around for 1998 financial crisis. I negotiated that bailout for LTCM. 98 was interesting because it was an acute financial crisis that came very close, within hours, actually. And I was in the room with the Treasury and Italian Finance Ministry and 19 banks and a thundering herd of lawyers trying to save the world. But we came within hours of shutting every market in the world. There was a $4 billion all cash. You couldn't use the word due diligence because there wasn't time. It was just, hey, the Fed wants us to do this, so let's just do it. So that worked. But it was a very close call. They would have shut down Tokyo and then around the world, London and finally New York. And they would have opened days later. But that's how, with trillions of dollars of losses, it would have been worse than what actually happened in 2008. It didn't happen, but there was no economic recession at the time. That confuses a lot of people because, and particularly if you're using 2008 as a frame of reference. There are financial panics and financial crises and liquidity crises, and there are recessions, some of which are severe. But they're two different things. 98 was an acute financial crisis with no recession. 2000 was a mild recession, but there was no severe financial crisis. Now, NASDAQ collapsed, but there wasn't a lot of leverage in NASDAQ. There was no contagion there, but it didn't spread because no banks failed, no major brokerages failed, et cetera. So in 1990, a mild recession, but no financial panic. October 1987, interesting, stock market fell 22% in one day. Not a week or a month, but one day, down 22%. And that was a financial crisis, but there was no recession. So they're separate things. However, they can happen together. And 2008 was an example. There we had both. But I would encourage analysts to separate those two things. Again, they came together. It was horrific, but they can happen separately. My point is, what's coming is a very severe recession. The monetary tightening on top of a world where growth is deaccelerating, inventories are sky high. The funny thing about the supply chain, we all remember headline, supply chain is broken down, the shelves are bare. So all true. That was happening at the time, and that's when I started working on the book. But what a lot of purchasing managers did, and inventory managers, they doubled their orders. They said, or tripled the orders. They said, if the supply chain's breaking down and I want just a normal amount, I better order 3 times as much or twice as much just to get what I want. And they did. Well, what happened was by the summer, some of that pressure had been alleviated, and here come the shipments into the warehouses that are twice as much or 3 times as much as what you needed at the exact same time that the Fed was destroying demand. And so demand drops off a cliff, retail sales drop off a cliff, the warehouses go from being empty to being full to the rafters, and now all that merchandise is sitting there. So, Nike, just many examples. So what do you do when you're in charge of inventory? You cut prices. You don't want that inventory. It costs a lot of money to keep it in the warehouses, number one. Number two, a lot of it's seasonal. It's like, who wants to buy, summer dress in December? Not too many people. So they just slash prices, and that reduces margins and reduces profits. So we're just kind of flying into the face of all that. With the Fed tightening rates into weakness, the Fed will be the last to know because they're very model driven and the models are badly flawed, mostly with the Phillips curve, and they're focused on the unemployment rate, which is not a good measure of what's going on in the labor force. So my expectation is the recession's coming. It's going to be really bad. Inflation is going to come down fast, but not quite fast enough for the Fed. They're going to keep raising rates, destroying demand, raising unemployment. And we're going to wake up with a severe recession, high unemployment, and a much lower stock market. I write books and I also write several financial newsletters. So I'm thinking about topics all the time. And there's always one, usually I say, well, all right, this war in Ukraine is a really big deal. Got to cover that. Or financial implosion in China, really big deal. Got to cover that. Or what's going on in the U.S. and other topics. I could give you a long list, maybe the end of the dollar's role as a global reserve currency, et cetera. The difficulty now, they're all going on at once. Any one of those topics would, fill a newsletter or be a big topic, a heavy lift, but they're all going on at once. And number two, they're not unrelated. There are all kinds of correlations. The breakdown and collapse of the global supply chain, which preceded COVID. A lot of people say, well, COVID came along. Of course, it messed up the supply chain. In my new book, Sold Out, I've got very, very good documentation that shows the supply chain was breaking down before COVID. Now, of course, COVID made it worse. Yes. And the war in Ukraine made it worse yet. Yes. But this really started with Trump's trade war in 2018. So, that, like I said, there's a thread that runs through all these things. So, when you ask me that, I'm thinking, well, you want to talk about China, Ukraine, supply chain, they're all a big deal. The war in Ukraine is the most important because it's highly, highly significant economically and strategically. But of course, it's a human tragedy going with it. If Chinese real estate implodes, okay, there's some hardship here and there, but it's not like people being killed or maimed or forced into refugee status. And that is part of what's going on in Ukraine. So that's probably the biggest single one, but I wouldn't miss the fact that all these things are going on at once. It's interesting because I do have, kind of an international following, but there are certain pockets. I mean, there are certain countries where, there's interest in what I do, or my books are published in that language, et cetera. So I have a good German following, and of course the Germans want to know what's going on with energy, Japanese following. The number one question, of course, everyone's concerned about inflation, but there's a big backstory there. But I always say when it comes to your own money, everybody has a PhD in economics. You don't need Larry Summers to tell you what's going on with your budget and your, ability to feed your family or keep a roof over your head. So people get inflation. It's one of the reasons it's so politically toxic is because it's unavoidable. You can't fudge it. You can't spin it. So people get it. But then from there, the question I get the most is, hey, Jim, is this going to cause a recession? Are we going to have a recession? And as recently as a few months ago, I would say, yeah, I think so. You can see it coming. And there's data. I never make statements like that without supporting it. There's a lot of whistling past the graveyard. I mean, the stock market is still greatly overpriced. There's still, the buy the dips mentality hasn't gone away. It's still there. You got people like Jim Cramer yelling, and there's institutional support. There's momentum trading. Of course, 95% of the trading is by robots. So all that's going on. So we haven't really seen the market collapse, stock market collapse that I would expect in association with a severe recession has not happened yet. This is just going to play out. It'll get worse as the year goes on. I mean, that is my expectation. I have my own models and I look at it closely. But if you listen to Michael Berry, Jeremy Grantham, Charlie Munger, these people have been around and they run, hundreds of billions. And they're saying the same thing. So, so every now and then someone will throw some statistic at me and I go, how long is your time series? And I go, oh, we took it back 5 years. I was like, talk to me if you've done it for 100 years, because that's a little more meaningful. But Jeremy Grantham actually did do a 100-year time series and looked at bubbles all over the world, 1929 US, 1989 Japan, 2000 dot-com stocks, and many others. And he said he's never seen anything like it. It's the greatest bubble of all time, real estate, stocks, and other asset classes. So, I do, that is my view, but it's shared by a number of other analysts. And again, you have to remind people, 1929, everyone's like, October, I think 18th or 19th. It was late October 1929. The stock market fell 22% in 2 days. It wasn't one day. It was, it was like 12% one day, 11% the next day. So 23% over 2 days. But that wasn't the crash. I mean, that was the beginning of the crash. This Dow Jones fell 82%. From top to bottom. Now, it took 3 years. It bottomed in June 1932. Started in October 1929, so not quite 3 years, but that fell 82%, and that happens. So we're down. Nasdaq's down, bounced back a little bit, down over 20%. We're in bear market territory, but that's just the beginning. That's not what a full bear market, market adjustment looks like in the face of the kind of recession that I expect. The soft landing is a myth. There's not going to be a soft landing. It's going to be a hard landing. That's not priced into markets. The markets are pricing in a soft landing. They're not pricing in a really hard landing. So you have what's called cost push inflation. That's where, supplies choked off, or there's an embargo, or there's a shortage, natural disaster, a lot of things. It's coming from the supply side, and demand is inelastic, so you just pay up or, kind of do without. we are starting with the cost push inflation, mainly the price of energy, but the price of food is a big factor. And of course, they're related. It's like, here's the energy, here's the food. Where do you think the food comes from? To get the food, you got to feed the pigs and cows. What do you feed them? You feed them corn. How do you get corn? Well, you grow it on a farm. You need nitrogen fertilizer. You need diesel in your tractors. You get the food. You got to put it in a truck to get it from point A to point B. That requires diesel. The higher the diesel price, the higher the cost of food because you're moving it by truck, et cetera. So these things, as I say, are linked. But food prices are going up substantially, and the two things you can't do without are gas in the car and food. So you have that cost push inflation, and you see that in inflationary expectations and inverted yield curves. And I'll come back to that because that's a really big deal. If you thought inflation was going to run away, as it did in the 70s, yield curves would be steeply sloping, and people would be in a frenzy to buy stuff. They're not. And the yield curves are not sloping, or upward sloping. They're inverted. They're going down. That tells you that, and we also see it's inflationary expectations. Inflationary expectations don't drive inflation here and now. What does is inflation here and now can feed on itself. Inflationary expectations don't drive it, but they tell you a lot. They're information rich. They tell you a lot about what people expect. What the yield curve is telling us, what inflationary expectations are telling us, and other factors are telling us is that, there's inflation now, but the Fed's going to kill it, and they're going to kill it by destroying demand and throwing us into a recession. And here's where it gets interesting, because you could flip from this kind of inflation to disinflation or even deflation very quickly. And people are definitely not prepared for that. Well, sorry, I shouldn't say that. Kind of everyday consumers are prepared for it. I'm not sure Wall Street and mainstream economists and policymakers are prepared for it. They're just extrapolating the inflation, saying, well, the Fed's going to kill it. Yeah, they might kill it, but at a price, at a very steep price. And consumers are really bracing for that. So the soft landing is a myth. There's not going to be a soft landing. It's going to be a hard landing. But that's not priced into markets. The markets are kind of pricing in a squishy landing or soft landing or from the runways. They're not pricing in a really hard landing, and that is what we're going to get. I don't match the company to the exact number, but layoffs on order of magnitude 10,000 to 20,000 terminated employees at Google, Amazon, Facebook, and other tech names. It affects other sectors as well, but tech in particular has engaged in a massive series of layoffs. And so people go, well, wait a second, how come it hasn't shown up in the unemployment numbers? Because the unemployment rate is it's around 3.5 on the exact numbers. We haven't seen that level of unemployment, that low, that is, since the 1960s. And the Fed is absolutely looking at that. And of course, they believe in the Phillips curve, which is junk science. But the Phillips curve, for those who are not familiar, says there's an inverse relationship between unemployment and inflation. So if unemployment is high, inflation is low. And if unemployment comes down, inflation goes up. And so if you want to get inflation down, you should expect to bring unemployment up. That's what the Fed believes. What I just said is nonsense. It's not true. If you think of a matrix of unemployment and inflation, what did we have in the late 1970s? We had high unemployment and high inflation. What did we have between 2009 and 2019? We had low unemployment and low inflation. What do we have now? Low unemployment and high inflation. So as you can fill in every box in the matrix, which means there's no correlation. I mean, you can describe it, you can calculate it, you can put it on a chart, but there's no correlation. Last time I looked at the Phillips curve, it was flat. At least where I went to school, curves were curved. So it's junk. But the Fed believes it. Again, it doesn't matter what I think. It matters what the Fed thinks. They say you got to put yourself in their minds to figure it out. So as far as they're concerned, those kind of unemployment numbers, lowest since the 1960s, that's inflationary. They got to get those numbers up. Now, having said that, what else is the Fed missing? Well, wages are up 5% on an annualized basis, 5.2% on an annualized basis. I'm like, yeah, so your real wage just went down. Because when the Bureau of Labor Statistics reports those wage numbers, those are nominal numbers. I'm not saying they're fake, but you have to know that they're nominal, and you have to subtract inflation to find out what's happening to real wages. And the answer is real wages have been going down for a couple of years. It runs around 5% annualized, give or take. Sounds like, hey, 5% raise, what do you want? Well, yeah, but your real wage is going down. So that's not a robust number at all. The Fed, by the way, the Fed wants to make it worse. The Fed agrees that those wage gains are too high. But my point is, in real terms, they're actually going down, but the Fed wants them to go down more. That would be one way to put it. If you get inflation down and wages are constant, then the real wage goes up relative to where it was before. But if you're unemployed, you have no wage. So that's another issue. Now, what the Fed is missing, and it's a long list, but there's something called the labor force participation rate. Now, the labor force participation rate, you just take the number of people working divided by the total working age population. It's all you do. It's not sophisticated. And that number today is around 61.2, give or take, percent. But as recently as 2000, that number was over 70%. And has come down ever since. And it dropped like a stone during 2020, during the pandemic lockdown. Came back a little bit, but not much. First of all, it's never 100%. It shouldn't be. There are legitimate reasons to be working age population not working. You're a homemaker. You're a student. You're an early retiree. There's a bunch of perfectly good reasons. So it's never 100%, not even close. But 70 is pretty high and 60 is pretty low. And the trend has been down. So that leaves, relative to kind of a normalized number, that leaves about 8 to 10 million people between the ages of 25 and 54 who are not in the workforce. And again, even if you allow for legitimate reasons for a lot of them, there's a big untapped labor pool. There are a lot of people who are sitting home watching, the football playoffs and not going to the unemployment office. That's the thing. You have to go to the unemployment office online or whatever. You have to at least look at a job to be counted as unemployed. If you're not looking, you're not counted as unemployed. But you're still a person. You're still capable of working. You're just not looking, which is a very negative sign, by the way. But if you took that group and threw it into the unemployment numbers, the way the Bureau of Labor Statistics calculates it, unemployment would be about 9%. That's a depression level of unemployment. The dollar, of course, it was, on a tear in 2021, most of 2022. It got to levels maybe technically not higher than 2000. Now, dollars come off a little bit, kind of starting in October, but I think that's about at the end of its adjustment, and the dollar's going to get stronger again. And the reason I say that is it's consistent with everything else we're talking about. If we're talking about the kind of recession that I've described, and if we're looking at the kind of yield curves, apart from the fact that it's reliable warning of recession, which it is, what's behind the curtain? What are the real reasons why the yield curve is inverted? It's sending a very bad signal. We interpreted the signal, but why? Why is it happening? The answer is there's a mad scramble for dollars. There is a serious dollar shortage, and people roll their eyes. They're like, wait a second, China's dumping treasuries, Brazil's dumping treasuries, people hate the dollar. China's talking to Saudi Arabia about paying for oil and yuan. What do you mean there's a dollar shortage? Well, there is. And we can see it, but there's a reason for it. 1 quadrillion is 1,000 trillion. That's approximately the notional value of all the derivatives, off-balance sheet derivatives of all the banks and hedge funds in the world. It's about 1 quadrillion. We're talking options, futures, swaps, swaptions, FX forwards, the whole thing, but they're all off balance sheet. So they don't show up in, conventional ratios. You got to read the footnotes and they don't tell you that much. So, okay, what supports that? How do you get a $1 quadrillion position, 1,000 trillion? Well, the answer is collateral, but not that much. It's a little sliver. It's kind of like 1% collateral under the 1 quadrillion. Okay. So in a credit crunch, you're going into recession, which is where we are. What do banks say to each other, and what do banks say to the hedge fund clients, et cetera, in terms of the quality of collateral? They say, I don't want your mortgages. I don't want your corporates. I don't even want 10-year treasury notes. I don't want 5-year treasury notes. I want treasury bills. That is the best, least volatile, most liquid, most creditworthy instrument in the world. And in a world where balance sheets are contracting, credit fears are rising, the economy's turning down, everyone's worried about this. Well, if you're Deutsche Bank or Barclays or HSBC or Unicredit or Banco Santander, you have a central bank that doesn't print dollars. ECB can print all the euros you want, doesn't print dollars. Where are you going to get the dollars? Well, if you want to buy dollar-denominated treasury bills, you got to get dollars so you can pay for them. That's what will drive the dollar higher. So they're desperate. They have to get dollars to prop up their own banks. If you're the People's Bank of China, you got to prop up the Chinese banking system. If you're the Swiss National Bank, you got to prop up Credit Suisse, etc. The Fed will actually give you all the treasury bills you want. All you have to do is just do a reverse repo with the Fed. You deposit your cash with the Fed, and they send you treasury bills, and it's like, can be overnight, 1 week, whatever. And at some point you unwind it. But what you usually do is just roll it over. So a phone call to the Fed will get you all the treasury bills you want. So why doesn't that solve the problem? The answer is the Fed bills cannot be rehypothecated. They can't be used the way the dealers want. They can't send them to Deutsche Bank. But if I buy the bills at auction, I can. And so there's a liquidity preference for buying treasury bills at auction because I can pledge them to somebody else, and that's what they do. But if I do the reverse repo, I got to hang on to them because the Fed won't let me rehypothecate. And so that's why the yield to maturity at auction is lower than what the Fed will give you for basically for free. But it's another one of these weird, quirky little inversions, but it tells you something. It tells you exactly what I said, which is there's a dollar shortage, and that will get worse as we go into a recession and credit losses pile up and banks get stressed and balance sheets get reduced and dealers say, it's treasury bills, give me a 4-week bill. That's going to drive the dollar higher against basically the euro. So the global economy is in bad shape. It's going into a recession. Now, a lot of people have said that, we're going to have a recession as if it's no big deal, but they're expecting a mild recession. And I see a much more severe recession based on a lot of factors, some of which we've spoken about. Now, the other half of your question, which is important to listeners, is what does this mean for financial markets? And there, the best way I've been able to explain it, imagine you're in an Irish pub and you got 3 Irish storytellers. And I'm part Irish, so I can talk about the Irish, but they're telling 3 different stories, and you got to listen to each one. So there's the Fed story, the market story, and then there's something called reality, what's actually happening. So the Fed story kind of goes like this. The Fed, forecasting what the Fed's going to do is the easiest thing I do. It's not because I have a crystal ball or I'm smarter than anyone else. The Fed actually tells you. All you have to do is listen and believe them. Now, a lot of people don't listen, or they listen like, oh, the Fed will never do that. They will. They actually mean it. The conundrum is, okay, they've been raising rates since March 2022. Monetary policy works with a lag. Inflation peaked in July 2022, and it has been coming down ever since. That's, some months were, February was a little hot January was hot compared to December. But the trend has been down. So they're raising rates and inflation is coming down. So that's good. But here's what they don't know. Was inflation coming down because they were raising rates? Or had they already hit the terminal rate and they just didn't know it? Because Wall Street was like, no, you've hit the terminal rate. Stop, please stop. You got this under control. The Fed doesn't believe that. One of the greatest blunders in monetary policy was Paul Volcker in 1980, who had started raising rates in 1979 and inflation was coming down. But then in 1980, we had a very sharp recession that had nothing to do with monetary policy. It wasn't caused by Paul Volcker. Jimmy Carter put a cap on credit card interest, and banks stopped issuing credit cards. So, well, that'll sink the economy. And then so Volcker reacted to that by lowering interest rates 7 percentage points, not 70 basis points, 7 percentage points, because we're in a recession, right? That's what Feds do. The Fed chairs do. But because it was a regulatory blunder, they fixed it and the economy came roaring back. And then inflation really took off, worse than when Volcker got in 79 and early 1980. So Volcker had to take rates to 20% to get inflation under control the second time after cutting them in 1980. And that's called the Volcker mistake or the Volcker blunder. And Volcker himself, I spoke to him, he said that was a mistake, that I should have stuck to my program, not worried about the economy and unemployment, but just got inflation under control. But when he threw in the towel prematurely, the inflation went to the moon. This is a central banker's worst nightmare. I talked about how the Fed is blundering because they're raising rates too high, too fast, etc., and they are. But the Fed has always said, we don't worry about inflation. We don't like it. but we know how to get rid of it. We just raise rates, and maybe they got to raise them longer and further than people expect, and maybe it's painful. There are costs involved, but they can kill inflation just by raising rates. They don't know how to stop deflation. I mean, how do you stop deflation? You can't raise rates. That'll make it worse. You can go to zero, but that doesn't, once you're at zero, you're at zero. QE doesn't work, by the way. It's been tried to the tune of like $9 trillion, but the empirical evidence is that it's just, they do QE by buying bonds from the banks, and the banks take the money and give it back to the Fed as excess reserves. That money never goes to the economy. What good does that do? And the answer is it doesn't do any good. Jay Powell doesn't want to be that guy. Jay Powell knows that episode as well as I do. And he doesn't want to be the guy who throws in the towel early and then inflation just goes to the moon, and then then he has to take interest rates to, 15% or something ridiculous. So Wall Street's saying, you're already there, mission accomplished. Powell's saying, not so fast. They told Volcker that, and he cut rates, and it was an enormous mistake. So Powell's not going to be that guy. So what is the terminal rate? 2 weeks ago, it was 3 weeks ago, I would have said 5.25. Today, I would say 5.5, because we had a lot of hot data, unemployment down, job creation up, retail sales up, not to the moon, but these are the opposite of what Powell is looking for. So he's had no confirmation that inflation is coming down on its own. He's had a lot of data that says inflation may be getting ready to take off again. So you got to say the terminal rate went from 5.25 to 5.5, maybe more. Let's, see what he does in June. So that's and Powell already said, I don't care if there's a recession. I don't care if there's unemployment, because the long-term costs of inflation are going to be much greater than those short-term problems. We got to suffer through that to get a bigger problem under control. These are the three danger zones under threat of economic collapse I'm concerned about most, and I'm going to talk about each one now. Danger Zone 1, America's food supply. According to the CDC's website, a disaster can easily disrupt the food supply at any time. In the event of disaster or emergency, they advise Americans to have at least a 3-day supply of food. But have you ever asked yourself, what happens if multiple disasters hit our food supply chains simultaneously? So you can take rates to zero, but you're stuck. Could you have negative interest rates? In theory, yes. In Europe, Switzerland, and Japan did. But there's no evidence that it provided any stimulus. I mean, they did it, but it's like an experiment that didn't work. So the problem with deflation is there's nothing a central bank can do, and it does feed on itself, and it does get worse, and that is a central banker's worst nightmare. It means that you may not like the price, but you have no choice. You've got to go to work, take the kids to school, deliver goods, use your truck and your job, whatever it is, you have to do it. You have to pay that higher price. But it means that $75 extra at the pump, maybe twice a week, so $150 a week. That's $150 you don't have to spend on something else. Could be concert tickets, a show, dinner, a new dress, a new suit of clothes, whatever it might be. You're not going to buy that because you've just spent that much money on the gasoline. Well, that means all those other industries suffer. Retailers have lost sales. Restaurants have empty tables. Concerts have empty seats, and so forth across the entire spectrum of goods and services. Well, soon enough, that results in layoffs, some business failures, price cuts, etc. And that disinflationary and deflationary trend ends up in a recession. Danger zone number 2, America's energy supply. See, even after a trucker strike, the only way the trucks can deliver our food is if they have enough gas to run on. And right now, we're in the middle of the worst energy crisis since the 1970s. And not just because of rising prices at the pump. As you may know, in the aftermath of that oil crisis, our government built something called the Strategic Petroleum Reserve, SPR. For a worst-case scenario, we all hope never comes to pass, over the last 50 years, it's grown steadily from administration to administration, having recently hit 564 million barrels of oil. And then suddenly, everything changed. And while the situation surrounding the way we get our food and energy is bad, it's this next danger zone that keeps me up at night. Danger zone number 3, America's medicine supply. Think about it. We're the world's largest economy. That means we have a bullseye on our back. I believe a coming conflict with China, it could be another trade war,